The outcome of the US presidential election has caused inflows to emerging market asset classes to pause, and with it the rally seen since the beginning of 2016. So what is the outlook for 2017? Well, let's start with US politics. The expectation of reflationary fiscal policy in the US has caused yields to rise and the dollar to strengthen, and traditionally this acts as a drag on emerging market relative performance. Secondly, US trade policy. Well, we're waiting for clarity here, but there is concern about the renegotiation of trade agreements with emerging markets. So where does this leave us? Well, markets have already partly priced in a stronger dollar and the rise in US yields. And on a trade basis, we actually expect a more moderate outcome than campaign rhetoric would suggest, based on global supply chain integration and geopolitical considerations. Furthermore, there are actually some key supports for emerging markets. Firstly, growth is expected to increase in 2017, led by cyclical recovery in key economies Russia and Brazil. Secondly, we think we are at the trough of the return cycle. Corporates are focused on improving cost efficiency, improving capital allocation, and this has already led to a stabilization in margins, and we think will improve returns going forward. Thirdly, valuations are attractive, and improving returns should drive a re-rating. And fourthly, positioning is light. In 2013 to 15, we saw $120 billion come out of emerging market equities, and very little of that money has come back. So we remain fully invested. But in an environment of muted global growth and uncertain policy, there will be differentiation. And we work to identify the countries and the companies that are best placed to succeed.